All right, let's dive into the 2026 housing market, because right now, it feels like it's being pulled in two completely opposite directions. It's this incredible story of some really solid underlying strength colliding head-on with a sudden, pretty disruptive shock.
So that leads us to the big question on everyone's mind, right? After what was a really calm start to the year, has the market finally hit some kind of critical tipping point? Well, let's break it down and find out.
2026 kicked off in what was pretty much a dream scenario for housing. We had low mortgage rates, which is great, but just as important, there was almost no volatility. It was stable, it was predictable, just a really healthy environment for pretty much everyone involved.
And this was the magic number. For that whole first part of the year, mortgage rates were just humming along, staying comfortably below 6.25%. That stability, that was the key. Let the market just work. But yeah, that all changed in the span of one single week.
And this is where the plot really thickens. That whole period of calm, it was completely shattered by something nobody really saw coming, an external event that just sent shockwaves through the entire financial system.
So, what was the trigger? An escalating conflict with Iran. Now look, this isn't a geopolitics explainer, but what's so important for housing is how stuff like this injects pure chaos and uncertainty into the bond markets. And the bond markets, they're directly tied to the mortgage rates you and I pay.
And boom, just like that, the low-rate party was over. Rates didn't just sneak past that 6.25% line. They blew past it, ending the week at 6.41%. The sheer speed of that move completely flipped the script for 2026, and it left everyone wondering, okay, so what happens now?
But here's the thing. Despite that shock, there's a really compelling argument to be made that the market is a whole lot more resilient than you might think. So, let's talk about the bull case, and it all starts with a concept called mortgage spreads.
So, mortgage spreads, what are they? Think of it like this. It's the gap between the baseline government bond yield and the actual mortgage rate you get quoted. For most of 2026, this spread has been normal and stable, and it's acted like a giant shock absorber, protecting all of us from even crazier volatility.
And I mean, this chart just lays it out perfectly. It shows you how massive of a difference this makes. Yeah, 6.41% is where we are today. But if we had the same wide, crazy spreads we saw back in 2023, that rate today would be a staggering 7.59%. These better spreads are honestly the unsung hero of the 2026 market. They're preventing a much, much worse scenario.
Okay, the other huge part of the bull case is just simple, powerful demand. And we see this clearly in the purchase application data. You can think of this data as kind of a crystal ball for the housing market. It tells us what sales are probably going to look like 30 to 90 days from now.
And wow, the numbers here tell a really powerful story. Demand isn't just hanging in there, it's strong. We're talking 9 straight weeks of positive year-over-year growth, and 6 of those weeks were in the double digits. That points to a really consistent, motivated pool of buyers out there.
And it's not just people applying for loans, it's actual contracts getting signed. The weekly pending sales numbers are also trending higher than they were this time last year. So all the signs point to a consumer who still really wants to buy a home. But, well, that brings us to the other side of the story.
All right, so for every bull, there's a bear, right? Let's look at the bear case. For every positive data point we just saw, there's a flashing warning sign. And honestly, it all revolves around one thing: those rising rates.
Historically, the market just seems to have this psychological wall right around that 7% mark. When rates get close to that number, or cross it, we see demand just fade away. Buyers hit the brakes, and the market can really stall out. And at 6.41% and climbing, we are getting uncomfortably close to that danger zone.
The next warning sign is inventory. Now, inventory is still going up, which is good. But, and this is a big but, the rate of that growth has absolutely fallen off a cliff. We went from a huge 33% year-over-year growth rate in 2025 to just over 6% last week. The supply of homes out there is getting tighter. And a big reason for that tightening is that fewer people are actually putting their homes on the market to begin with. New listings are still lagging behind where they were last year. So if you've got strong demand meeting slowing supply, well, that puts pressure on prices and makes the whole market that much more sensitive to these rate hikes.
And this last point really shows how little wiggle room there is right now. The percentage of sellers who are cutting their prices is actually lower than it was last year. Now, on one hand, that means sellers are feeling confident, but on the other, it means the market has lost its cushion. There's just less flexibility to absorb the shock of rates going up this fast.
So, where does all this leave us? Well, basically in a classic standoff. It's a true tug of war between two very powerful, very opposite forces. The big question is, which one is going to win?
So you've got the bull case on one side, that resilient consumer demand helped out by those better mortgage spreads. And on the other side, you've got the bear case, the disruptive force of rising rates pushing us toward that 7% danger zone, all while inventory growth is hitting the brakes.
And where we go from here is probably going to be decided by three key things you need to watch like a hawk this week. First, that ongoing Iran conflict. It's driving the bond market. Second, the new PCE inflation data. That's going to tell us if price pressures are getting better or worse. And third, the tone we get from the Federal Reserve at their next meeting.
As the source material puts it, and I think pretty perfectly, buckle up, folks. Next week might be the craziest yet. I mean, the stakes right now are incredibly high, and the entire market is just holding its breath waiting for the next signal.
Which, of course, brings us right back to where we started. The housing market is truly on a knife's edge, caught between these strong fundamentals and a powerful external shock. The only question left is, what's going to be the thing that finally tips the scales?